Greetings and welcome. It's so great to see old friends and new joining today for the Community Foundation for Northern Virginia session on navigating the new landscape, what the One Big Beautiful Bill Act means for philanthropy and planning, and your philanthropic goals and working with your clients. I want to thank the team for putting this session together today. I thank everyone for joining, and we are joined by a stellar group of thought leaders and experts. You will hear from them in this order. You see their faces on the screen, and you will hear from them momentarily. We're joined by Jeff Hamond, Van Scoyoc, Devin Johnson, Mason Investment Advisory Services, Jim Head from BDO's National Tax Office. We have built in time during today's session for Q&A. We thank you again for taking the time to join. Again, the members of the professional advisor community, members of the Community Foundation for Northern Virginia Board of Directors, as well as fund holders and partners and supporters of the foundation. We aim to bring sessions such as this to you with real-time, relevant, trusted information, especially as advisors are working with their clients to help them make the best decisions for their unique tax and planning and wealth needs situation, and then also for fund holders and partners so that you can work collaboratively with your network of professional advisors. So with that, I'm going to turn it over to Jeff Hamond, first speaker. Devin Johnson will follow, Jim Head, and over to you, Jeff Hamond. Thank you again.
Hi, everybody. So I wanted to explain just for a minute kind of who I am and set the stage for everything a little bit. So I used to be a Senate staffer. I was a Senate staffer for a long time and realized recently that I've now been off the Hill longer than I was on the Hill. So, well, there's my Chuck Schumer slide. So this is just to show how long I was on the Hill, and look at how slim and young Chuck Schumer and Lindsey Graham are. So I'm the lobbyist or representative for community foundations. In about 2012, there was a partnership started to give community foundations their own voice in DC, and I coordinate the work of that partnership. We started with about 18 foundations, but we now partner with about 170 around the country. And our partnership represents not just big foundations, we represent lots of small and mid-sized foundations as well, big and small, blue and red state, urban and rural. And the Community Foundation of Northern Virginia is a participant and supporter of our work, and that's how I know the foundation and I know Renee. And I'm actually also a donor to the foundation as well. And so one of the things that we'll do is we'll bring CEOs to DC, for example. Let's talk about the One Big Beautiful Bill and some of the relevant provisions for community foundations. I'm going to touch on these very quickly, but then I'll talk about a few of them in more detail. So what I would put in the good or goodish category is the increase in permanent child tax credit, or the increased child tax credit, which is good for the populations community foundations serve, even though it doesn't benefit community foundations directly. The charitable deduction for non-itemizers at $1,000 for individuals and $2,000 for families. Removal of the terrorist 501c3 language, which I'll talk a little bit about again, and nothing on donor advised funds, which I know many of you as professional advisors, I was actually surprised as someone who advocates for community foundations that this bill was totally silent on donor advised funds, given how much attention donor advised funds have received in recent years. Some of the issues that are continuing cause for concern, the House bill had a large increase to the private foundation excise tax on investment income for larger foundations. That was removed, but the House inclusion itself was problematic. A limitation on deductibility of deductions for top earners. The standard deduction made permanent, which is good for taxpayers generally, but not necessarily great for many charities because the number of itemizers, or the percentage of itemizers, is only around 10 or 12%, whereas back before the 2017 tax law, almost a third of taxpayers itemized, and an increase in the university endowment tax. Very concerning are several of the cuts used to pay for the tax cuts. SNAP cuts, Medicaid cuts, changes to Pell Grants. In the nonprofit sector, many of the clients I work with are concerned about this continued focus on the nonprofit sector as kind of woke, even though they're serving needy populations. And so that's something that a lot of us are paying attention to. And in the category that I would call prognosis unclear, you have the Trump accounts that kids get at birth to help them build a nest egg over time. You have the floor on charitable contributions for individuals and corporations. And then there's a charitable credit in the bill for scholarship granting organizations, but that's really designed for religious schools. So we're kind of waiting to see how that looks. So let's go. The main tax issues for nonprofits and for giving that are in the tax bill. So the first bullet here is the Senate bill includes a $1,000 and $2,000 non-itemizer deduction for charitable giving. That's something that Senator Lankford of Oklahoma was very instrumental in pushing for, to make sure that all taxpayers had some sort of incentive to give to charity. Another provision is the limitation on itemized deductions at the 35% rate. So the top tax bracket is 37%. So at the very top, people are going to have a little bit less of an incentive to give, for example, because their deductions will be valued at 35% instead of 37. The question, I think, and we'll have to see how the tax data bears this out over time, is whether people will really notice that. Will it really have an impact on giving? Another provision is the language from HR 9495. This was a very concerning bill that passed the House last year that would allow the Treasury Secretary to single-handedly and unilaterally strip the nonprofit status for certain organizations that were deemed terrorist supporting. But those in the field were concerned that it could be used to target any nonprofit the administration didn't like. That language was not included in the bill. Another provision is, as I mentioned earlier, the 1% floor on corporate charitable contributions and a 0.5% floor for individuals. And the overall impact of these new giving floors on giving will be uncertain, as again, we're going to have to see how the tax data bears this out over time. Next slide. Another issue is that many of you are paying attention to is the permanent increase in the estate and gift tax exemption to $50 million per individual and $30 million for couples, adjusted for inflation. A higher university endowment tax, and I mentioned whether this is a signal for things to come, because I think that there are some in the House that don't just want to focus on universities. They're really looking at all kinds of different types of endowments. There's a pocket of folks in the Republican Party in the House who just don't really love endowments. Part of it's targeted at universities. There's also private foundations. Community foundations, of course, do not have their own tax definition. They're a public foundation. So we haven't seen folks in the House wanting to target us yet. But I do see a tendency among some on the Republican side, mostly on the Republican side, that are interested in all types of endowments and whether the rules should change there. However, the bill that passed just focuses on university endowments. The House bill included a tiered private foundation excise tax that raised the investment income tax for the top 2,500 or 3,000 foundations in the country, and significantly increased it for the top 25 or 30, the big foundations, Kellogg, Kresge, Ford, Rockefeller, Packard, Hewlett. That ended up not being in the Senate bill, but it's still something to pay attention to. And community foundations, interestingly, opposed this, even though arguably they could have benefited. When this happened, I had a group of community foundation CEOs in DC, and even though the partnership that I lead isn't a separate charitable entity, like it's not a separate C3, we don't always put out statements, for example. We decided we needed to put out a statement against this private foundation tax increase because we didn't like the target on philanthropy. We thought that we could be pulled into that. But arguably, if taxes go up on private foundations, it creates another incentive for somebody to create a DAF, for example, or go to a community foundation. So we wanted folks to be crystal clear that we didn't support this. And again, nothing on donor advised funds. Surprised, but not surprised. Surprised in that with all of the attention given to donor advised funds and how it's arguably the area of charitable giving that's increased the most, it is the fastest growing tool for people to give to charity and get engaged in philanthropy. Some of us were anticipating there'd be something on donor advised funds in the bill, but we're also not surprised because a lot of the provisions that could have targeted donor advised funds couldn't have gotten through the Byrd rule in the Senate, where they strike things from the bill that aren't primarily about spending and revenues. So I'm surprised, but not surprised. There's something we're going to keep paying attention to. Next slide. So a quick summary and recap on donor advised fund reform, just because I know that many of you are probably interested in this, given that there was a bill a few years ago on this topic. In 2021, Ray Madoff, who's a prominent donor advised fund critic, and John Arnold, a billionaire philanthropist in Houston, the Laura and John Arnold Foundation, that's John Arnold, they teamed up to push a reform proposal called the ACE Act, the Accelerating Charitable Efforts Act. Go to the next slide. And the ACE Act had a number of different reforms in it, but a lot of the reforms were built around one central idea. And the central idea was to split the tax treatment of donor advised funds into two basic buckets. The first bucket would have said that to keep the current tax treatment for donor advised funds, where you get a tax deduction upfront when you put money in the fund, donors would have to agree to spend their DAF donations within 15 years, kind of on a FIFO basis. So all the DAF sponsors would have to track money in, money out. The second type of DAF would have been called an aligned benefit DAF, where if a donor wanted a longer timeline, there'd be no tax deduction until the funds were distributed. So it changes the timing and the motivation for donors in terms of when they might want to set up a fund at a community foundation or other DAF sponsor. The bill received very little support, only 3 senators and 4 House members. And so one of the things that happened after that was the Arnold's people were interested in working more closely with community foundations. And going into this year, the critics wanted to do something with the support of community foundations. Madoff and Arnold even had a new set of proposals that never got introduced. And neither the House nor the Senate reconciliation bills, again, contained anything on DAFs, totally silent. And so even though I knew that they had this new package of proposals, we didn't want to go to the Arnold people and say, when is your new bill coming out? You can go to the next slide. Because I didn't want to be the kid like in 4th grade at the end of the day who says, teacher, where's our homework, right? You don't want to poke the bear. So we know they have this new set of proposals, but they never got introduced. I also want to say that my wife found this image for me online, and I just want to reinforce for everybody, this is not actually a picture of me at age 9, even though it's amazing how much it does look like me at age 9, but it is not me. So next slide. So a couple of other things I want to talk about, because some of you are probably following this as well, were the Treasury draft DAF regulations that came out in November of 2023, which made many community foundation CEOs' heads explode, hence the image I have here. The one that all of you probably heard the most about, which would have affected community foundations around the country, would have said that a community foundation or a donor to a community foundation would no longer be able to recommend their personal investment advisor to still manage the assets that are in the DAF, even though the DAF sponsor owned those assets. Many community foundations and other DAF sponsors will allow their own advisor to still manage those funds. The Treasury draft reg said you're not going to be able to do that anymore, essentially. So there was a lot of concern about that at the time. Second major part of the regs people were concerned with, more of a focus for Renee and her team, but less of a focus for the professional advisors, would have been, the second bullet, please, would have been to change the definition of a DAF to include more types of funds like field of interest funds and other types of things that many community foundations do, but Fidelity, Vanguard, Schwab, the other DAF sponsors don't do those types of funds. So this was a major concern for us at the time. The third major area was that the effective date would have been retroactive. So these were the 3 major area of concerns for community foundations. And then we were very strongly opposed. There was a Treasury hearing about the regs. 17 community foundation CEOs were among the 42 or 43 witnesses that testified. And so now the question is, what's going to happen with these draft regs? We think that a different administration coming in makes it very unlikely that these regs are going to be pursued. So those of us in the field are kind of assuming for the time being that even though they haven't been rescinded, and there are some senators asking for them to be rescinded, but we're assuming they're kind of dead right now, that the Trump people are not going to want to finalize Biden regs. So we think for the time being, these regs should be considered kind of dead or at least postponed. Next slide, please. So there are some things that community foundations are trying to fix, things that are on our wish list. The number one fix for many community foundations is to fix the IRA charitable rollover issue. Right now, you're not allowed to do a qualified charitable distribution to a DAF. This is a big issue for many community foundations because getting that donor in the door with the donor advised fund, possibly through an IRA rollover gift, is a very important tool for community foundations to build their network of donors over time and build those relationships. So this is something very important for us to fix. Another thing community foundations are looking at, which is what we've been successful at so far, is no major changes in donor advised fund policy in terms of payouts, especially fund by fund payout. For many of the community foundations I work with, an entity payout on DAFs would be okay. So that would be you're treating the community foundation as an entity, kind of like the way a private foundation is, where you'd say all the donor advised funds at your institution have to have an average payout across all funds of 5%. That type of change would be fine with most of the community foundations I work with. It's where you start doing a fund by fund payout that it becomes hugely problematic and cumbersome administratively. Another thing community foundations are looking at, which again is in the law, is a broader charitable giving incentive. Fewer people, again, are itemizing since the 2017 tax law. Another provision is to possibly address bifurcation. So this is an area where there's some disagreement among the CEOs that I work with. So right now, if you want to say fund a table at a charitable event and the table costs $10,000 and ordinarily 9,000 of that would be deductible because the food and the meal is worth 1,000, you can't use your DAF to pay for, in general, the otherwise deductible part of the table at the event. You can use your cash resources for that, but not the DAF. And there are some community foundations that would like to see that fixed. Their view is, if you can get a charitable deduction for it out of your cash, you ought to be able to use a DAF for it. So that's something that our field might look to fix. Another issue is to clarify that charitable recipients of beneficiary IRAs do not have to open accounts to receive funds. This is something I just started hearing about the end of last year, where a public charity that is named as a recipient of an IRA or part of an IRA after someone dies, the IRA administrator will often require an employee of the charity or the community foundation to open an account at the IRA administrator to get the funds first, and then the funds will be transferred over. So that creates some timing concerns. It creates some privacy concerns. Like, why should an employee have to open an account and give their social security number and give all that information when they're not the one benefiting from the money? So there are some lobbying groups in DC trying to fix that, and community foundations are among those that would like to see this fixed. Last bullet on this slide is, of course, continuing to make sure that people can support the causes they choose to without threats or attack. One of the concerns I've heard a lot about this year has been people feel like if they're giving to things that the Trump administration doesn't support, that they might be targeted. So, for example, a donor wants to fund legal services for migrants, just to pick an issue like that. Well, that donor ought to be able to, through the First Amendment, to give to whatever causes they want to support without feeling like they're going to be looked up and targeted in some way. So that's something very important to community foundations. Next slide. And then we're talking about the impact on philanthropy and the community foundation sector of some of these changes. So first bullet here is, the summary is the Senate bill doesn't contain the worst provisions and does have a larger charitable contribution in it. So that's a good thing. Second bullet, Republicans, though, still want to go after large endowments, progressive foundations, universities, etc. So this is something that we are continuing to follow. One of the reasons I got into this space before I even started doing community foundations was I thought it was a mistake for some of the nation's largest private foundations to not be engaged here in DC. Those of you who know tax law and some of the regs know that private foundations can't lobby. Community foundations can, but I still think there's a lot private foundations could be doing to talk to Hill staff like I used to be, talk to members of Congress, share their experience, talk about their grant making. I think it'd be good for foundations to do that so that people understand the work of philanthropy better. The third bullet is, again, the focus, again, has not been on community foundations or public foundations. This is one good thing about having a not having a tax definition. Let me talk about this just for a minute, because I think it's very interesting, and some of you on the call might be interested in this. One of the debates in our field has been whether community foundations should have a tax definition like private foundations do, potentially to say, have different tax rules for a community foundation DAF as opposed to a Fidelity DAF, for example. And so there's disagreement about that in our field. But one of the good things about not having a definition is that it's also harder to target you. And so we weren't targeted at all in this round of tax changes because we don't have a definition. We do think it's a bad precedent, though, for Congress to take money from charities to pay for expensive items. And I think there's a tendency right now to view the nonprofit sector as a pay for. And so our sector needs to do a better job talking about the work that it does and how it benefits everybody's states and districts. Now we're handing it off to Devin. So thank you, everybody.
Yeah, thanks, Jeff. It's obviously a difficult job to give us a 15-minute summary on an 800-page bill, but certainly learned a few things, so appreciate that. And I guess just a little bit about me and the firm I work for, if you want to go to the next slide. We're located right here in Northern Virginia. I work at an independent wealth management firm, and I come from a tax background in public accounting. And tax seems to be pretty much everything, or pretty much all that people want to talk about these days, so it works out. And I've also had the pleasure of working with the Community Foundation Northern Virginia in the past with their Raise the Region Gala, and I look forward to working with them again in the future as well. You can skip the next couple of slides, just go to the overview of the bill. There we go. Jeff obviously gave us that overview, so I guess my task today is just to add a little bit of color in terms of the impact the bill has on charitable giving, and as well as some of the strategies that we're already seeing or we expect to see in the coming months and years. I've heard someone call this bill a handful of paper cuts and band-aids, and it kind of depends, I guess, on the individual if you have more of one or the other. But I guess if I had to summarize, the main thing is that we now have a little bit more clarity, which also brings more complexity. We had this big looming deadline of the sunset of TCJA, and people were holding their cards close to their chest, not sure what to do. There was a lot of this wait and see approach in terms of tax planning and charitable giving. And now we can finally put to rest nearly 8 years of speculation of over what the tax picture of millions of Americans would look like now and in the future. So I also think it's interesting to note that the time of deductions between now and 2026 doesn't have as material impact to taxes as they might have been if TCJA did sunset, given that the standard deduction and the tax rates are now permanent, but there still are a handful of provisions that we want to discuss in terms of making charitable giving more tax efficient, knowing what we know now. So in terms of key changes, again, the bill came to 870 pages. Large swaths of the bill obviously have nothing to do with individual taxes, and even less are related to charitable deductions. But again, still a few nuggets. Jeff already gave us a highlight on some of these. Want to dive a little bit deeper. There's 3 or 4 main tax provisions that could significantly influence decisions on charitable giving strategies. So offering both expanded opportunities and important considerations for donors and advisors alike. The first is the above the line charitable deduction for non-itemizers, and that non-itemizers is important. And another couple key points is that this is a permanent provision and it will be starting in 2026. But basically, since the Tax Cuts and Jobs Act in 2017, there has not been very much incentive from a tax perspective to make charitable donations for many lower and middle income households. The large standard deduction it basically prevented or created a large hurdle rate before you could see the benefit of most charitable giving on your tax return. So the big bill now adds a new deduction for charitable donations for people who use the standard deduction. So if you itemize, this doesn't apply to you. But this isn't also a new idea. You might remember that during the CARES Act of 2020, it was passed during COVID. There was this temporary provision that created a new charitable deduction up to $300 or $600, depending on your filing status. But that only lasted 2 years and expired in 2021. This is kind of a resurrection of that idea, but now it's made permanent. And they're also higher. So starting 2026, as Jeff mentioned earlier, $1,000 above the line deduction for single filers, and then a $2,000 deduction for married filing joint filers. A couple of key points, though, is that the contributions must be in cash, and they can't be made to sporting organizations or used to establish a donor advised fund. There's also no income phase outs around these deductions and no inflation increases on these either. So really, what does this mean? It means that, if you or clients have been hesitant to donate, given the uncertainty around the legislation, knowing that there might have been more bang for your buck if tax rates went up and the standard deduction dropped in 2026. But we expect this to potentially increase participation in giving, and especially for the low and middle income ranges. There's also something interesting that you may see, or your clients may see as a potential scenario where you have slightly higher itemized deductions compared to the standard deduction in 2026. However, if you're within this small little window, it actually may make more sense to elect to take the standard deduction and then tack on that additional $2,000 in charitable deductions on top, since you no longer itemize, thereby maximizing your deductions on your return. So keep an eye out for that. You can probably go back to the slide that we were on previously. I'm spending most of my time here. Thanks, appreciate it. That slide kind of summarizes some of these things. So the second idea is this new floor on deductions for itemizers and corporations. And again, we know that we're no strangers to AGI limitations or maximums to charitable giving. So for example, cash contributions to public charities can't be more than 60% of AGI. But the big bill now adds a new wrinkle where we had a ceiling and now we have this new floor, new minimum. So specifically starting in 2026, again, a permanent provision, you'll only be able to itemize donations to the extent that the total of those donations exceed 5% of your adjusted gross income. So this new hurdle rate, again, is conceptually similar to what we've seen before on our Schedule A with qualified medical expenses. So before, you could not deduct medical expenses unless they exceeded 7.5% of your AGI. Similar concept there. So for example, someone with AGI of $300,000 could only deduct charitable donations in excess of $1,500. And corporations also will be entitled to deduct charitable contributions if they're over 1%. So a couple things here. It's also important to note that this new floor is being applied before the upper AGI limits. And there's also new ordering rules to specify which types of charitable contributions are reduced first. There's obviously different ways that you can donate: cash, securities, etc. And so there are some more complex rules that you need to follow and make sure that check those out to see if they apply to you. Another technicality comes with the carryover rules with charitable contributions. So in the past, if you exceeded those upper bands of your charitable contribution limits, you were granted a 5-year carry forward to be able to deduct those in the future. What's interesting is that this same rule now applies to cover the 0.5% limit on charitable contributions on the lower end. So in other words, you may not be subject to the 5% limit if you contribute more than, let's say, 30% in marketable securities. That would just be carried forward over to the next year. So again, something to consider there. So while we might be inclined to say, this is just a simple floor of 0.5% and move on, it is an area of the tax code that becomes quite complicated. We're managing floors, we're managing ceilings, carry forwards, and ordering rules. But in terms of, applicability and what does this mean, I would say that, the new floor on deductibility of charitable organizations means that for high income taxpayers who plan to make charitable contributions, it may be best to do so in 2025. Accelerate those deductions now before that floor takes effect in 2026. Again, bunching strategies, that's not new, but we've seen it in the past, we've used it in the past, and they continue to be very effective under the new rules. Corporations also will need to take advantage of bunching donations to make sure they exceed the 1% threshold as well. The third point here, the new limits to deduction for itemizers in the top tax bracket. Again, permanent, it's effective in 2026. This is, again, not necessarily a new idea. We've seen something similar before with the former PEAS limitations in the past, but this new legislation, it caps the tax benefits of itemized deductions at 35%. So again, kind of disincentivizing those high taxpayers to take charitable deductions. But it is 37% of all deductions, and charitable donations or deductions are not exempt from this limitation. So in other words, these high income filers donating $1,000 would only receive $350 deduction instead of $370. Or another way to think about it is normally if you had a deduction worth $1 in the 37% tax bracket, you'd get a deduction of 37 cents. But we are now capping that at 35 cents. And my understanding is that this comes in after all of your other previous limits and floors have been calculated on Schedule A, again, adding another layer of nuance. So again, kind of what I mentioned earlier, donors in those higher tax brackets who are considering a significant philanthropic gift may want to think about accelerating that gift in 2025 to maximize their deduction, because under the current marginal rate, before those caps go into effect, especially if you know you itemize and you're charitably inclined. Do you want to touch on one extra bonus point here that is not on here, but the tax deduction for donations for organizations providing school vouchers? Jeff mentioned this again, but it is a first of its kind federal income tax credit for cash contributions to certain state scholarship granting organizations. It's kind of a mouthful. We call them SGOs. And the credit will equal 100% of the contribution up to $1,700 per individual or $3,400 for joint filers. There's no income thresholds. This is permanent. It starts in 2027. So, you know, if this is something that you or clients or anyone you know is interested in, it's something that you want to keep track of for individuals interested in donating to these kinds of organizations, you know, regardless of if they're looking to deduct other charitable gifting. So it's certainly an interesting change. We can go to the next slide. All right, the standard deduction and SALT cap. So what we've been talking about previously, they kind of have a direct impact on our charitable giving. Some of these things, the bigger provisions in the bill that have kind of gotten a little bit more publicity, they also will indirectly impact our gifting, right? And, you know, in terms of the standard deduction increase, we know that something like 90% of taxpayers took the standard deduction after the Tax Cuts and Jobs Act, given that it was so large. However, given the current increase to the SALT cap, which again is temporary, so we're dealing with the crossover between the standard deduction, which is a permanent change, the SALT cap, which is temporary. We have to keep that in mind as we're considering different planning strategies. We do expect that more people will likely itemize. And when people itemize, they're likely to get more benefit from their charitable deductions when maybe previously in the past they didn't, even if we are subject to that 0.5% floor, which we talked about earlier. So again, likely able to deduct those contributions and if meaningfully more valuable than the standard deduction. So in terms of how do we manage this, there could be some interesting opportunities in terms of managing income, whether for yourself or clients, et cetera. For example, maybe we don't want to do that large Roth conversion if you're close to that $500,000 cap, that phase out for that the SALT cap it will be phased out if you're at the higher income levels. So considering different levels of income, you know, if you're making $600,000, maybe you want to look for opportunities to reduce your income or accelerate deductions to get under that threshold. So maybe consider putting more into a deferred compensation plan to defer that income to be able to get under that limit, to be able to get that deduction because it is a valuable deduction. Maybe take advantage of the new 401k super catch-up contributions, again, to defer your income. Maybe don't exercise stock options if they aren't about to expire, if it would bump you up into that higher income limit and phase you out of that benefit. Next slide. All right, so from an estate planning perspective, I'm not going to touch much on this because our friend Jim is going to cover more about this in the next section. But briefly, I'll just say that this is a permanent extension of the estate tax exemption. And it's been a big sigh of relief for those high net worth individuals who are possibly in that range of, if this thing sunsets, if TCJA sunsets and nothing happens, I'm suddenly going to be on the hook for what could be a large estate tax bill. But now that, you know, with this new bill, it's removed that immediate pressure to get in line at your attorney's office, which would have likely been out the door, and trying to get your estate documents updated for the new laws. So I think we're going to see a shift in focus from kind of a use it or lose it mentality to income tax efficiency. You know, we're no longer driven by this fear of that temporary higher exemption that might disappear. And, you know, we might focus and start focusing more on wealth transferring or focusing on reducing distributions from the investments within those accounts. So again, overall wealth transfer optimization, Strategies that might minimize capital gains taxes and shift income to lower tax family members may become more prominent instead of focusing primarily on that $15 million exemption. And there's almost certainly someone who can hear my voice right now that has something in their estate documents that was optimal before that, quite some time ago, that may not be optimal now. For instance, formulas within your existing trust that reference the federal state tax exemption might now allocate assets differently than intended due to the increased exemption amount. So it's crucial to remember that also states have their own separate estate and inheritance taxes. So these state level taxes have to often much lower exemption. So you have to, even though federal's been in the news, you got to be able to balance both the federal and state implications for estate taxes, if that applies to the state where you live. So I guess just in closing, you can go to the next slide. We've talked about a number of strategies, but I guess the takeaway, regardless of one's opinion on tax policy, is that there are a host of new deductions that add significant complexity to a household's tax picture. Tax planning, particularly for future years, is going to become harder, and more deductions, qualifications, and phase outs come into play. However, unlike TCJA that was brought in right at the end of 2017, we have more time in 2025 to be able to think through some of these things. We've talked about some strategies, some of them are new, some of them are old. However, other planning strategies, they might become more apparent as we have time to more fully grasp the laws, the scope of this new law. So it's going to take a lot of scenario planning, a lot of software is going to become ever more important as you look at different scenarios and what ifs and for your clients or yourself. So in summary, ask your CPA, ask your advisor if there are opportunities for you. Everyone is different. Everyone has different tax rates, different deductions, different credits. And if you don't have a CPA or CFP advisor, feel free to reach out and start a conversation. Other than that, I'm going to pass it over to Jim.
Well, thank you so much, Devin and Jeff. Although the new act cuts or eliminates certain credits and deductions, really it's surprising that it retained and made permanent many important tax provisions that were previously included in the Tax Cuts and Jobs Act. And this, as Devin points out, gives taxpayers much more tax certainty, which we definitely needed. But with that, as Jeff pointed out earlier, it's created a bit more uncertainty for charities, and especially as to whether charitable giving will indeed grow going forward. And to emphasize this concern, keep in mind that in 2017, before the Tax Cuts and Jobs Act was introduced, 31% of the US population itemized deductions. But by 2020, 3 years later, it was estimated that just 9% of the population itemized their deductions. So for 2026 and beyond, I mean, who knows what that percentage of itemizers will actually be? Well, with that said, we here at BDO think that in this year, 2025, many more people will make more charitable donations than they normally do before many of those provisions in the new act kick in next year. And here are a few charitable vehicles we are seeing clients using more and more to make gifts to charities. Charitable Remainder Trusts, or CRTs for short. Now, these can be very beneficial for individuals to meet their charitable objectives and also reduce and defer potential income taxes while also carrying out their estate planning goals. And now with higher interest rates, these CRTs are even more popular because in higher interest rate environments, the ultimate gift to charity will be larger, and therefore the charitable income tax deduction for the donor will be great as well. So CRTs, they're simply defined as tax-exempt trusts that are irrevocable, meaning the terms can't be changed once created. And these trusts pay a fixed amount known as an annuity or a fixed percentage of the value of the trust assets, which we call a unit trust or a qualified unit trust. Now, this annuity or a unit trust is paid each year to one or more individuals for a term of years or for life. And then at the end of that term, the remaining balance is paid to one or more charities that are generally named in the trust, or they can be designated later by the trustee or even the grantor. So let's take a quick look at how these CRTs operate. Well, the CRT, a donor can make a donation of cash, stock, real estate, even closely held business interests, other than S corporation stock. So you can't donate that. It'll disqualify the stock. And the donor can then take a partial deduction equal to the present value of the remainder interest in the assets that are placed in the CRT. Well, aside from the charitable deduction, there is an annuity or a unit trust payment that's made annually. So the donor or someone the donor selects, and this can even include the donor and the donor's spouse, will then receive this annual annuity or unit trust amount. And that amount has to be greater than 5% and less than 50% of the value of those assets that are put in the trust. And then when the trust terminates, which is again at the death of the surviving non-charitable beneficiary or the end of the term of years, if that applies, the balance then passes to charity. Well, that sounds pretty easy, right? Well, here are the benefits of this great charitable vehicle. One of the biggest benefits of CRTs is the tax deferral aspect of the trust, which is that fourth bullet point you see there on the slide. And remember, the CRT is a tax-exempt trust, so an individual will generally want to gift highly appreciated assets to that CRT, which can then sell those assets and then defer the taxable gain over many years as the annuity or unit trust payments are being made to the beneficiary or beneficiaries over that period of time. So this is especially attractive to many people where they're just about to realize a huge capital gain, perhaps on the sale of an appreciated asset, which would otherwise be recognized in their income tax in the year of the sale. But with the CRT, they can stretch out that gain recognition over years, if not decades. Now, oftentimes, the gain deferral feature of the CRT may be more important to a prospective donor than perhaps receiving a charitable income tax deduction on that remainder interest, which passes to charity. They may think that's actually secondary in terms of their priorities. So I often suggest CRTs to clients, even if they're not charitably inclined, simply to provide a wonderful means to defer over many years that tax on the substantial gains. Well, let's take a look at how a charitable remainder unit trust, a CRUT, works, because I think you'll see how valuable these trusts can be. And suppose you have an individual, age 55, he has $1 million worth of Apple stock and has a very low basis, $10,000. So there's a lot of capital gain that's going to be recognized there if he sells the stock. And he knows that if he sells that stock, it's going to be taxed at the rate of 23.8% for federal income taxes. That includes the 20% capital gains rate and the 3.8% NIT tax. And then he'll probably pay an additional 5% in state income taxes. But he also knows that if he sells it, he will have more money up front. But over time, the initial taxes will substantially reduce the earning power of those assets. So he decides to transfer it to a charitable remainder trust, a CRUT, for his lifetime because he'll actually receive more money in the long run and also greatly benefit his favorite charity. Well, under the terms of this CRUT, Mr. Smith is entitled to receive an annual distribution or unit trust payment equal to 5% of the value of the trust. In that first year, Mr. Smith is entitled to receive $50,000 from the CRUT as that annual unit trust payment. And then based upon the applicable Section 7520 rate, which is 4.8%, that charitable remainder interest would have a present fair market value of $295,950. And that's the amount Mr. Smith can deduct for federal income tax purposes, subject, of course, to his AGI limitations. And if not, he can carry it forward the next 5 years. So the chart here reflects that over time, and this is again at modeling, at the time the gift is made, the donor will receive $1.8 million in the aggregate, and the charity will get a whopping $2.13 million. So again, this is simply a model based on a presumed 25-year life expectancy and a 5% growth rate. And naturally, if the donor exceeds his life expectancy or the growth rate exceeds 5%, which it very well can in very good times, then both he and the charity may get a lot more than this model reflects. But the model will determine the present value of that remainder interest, which passes to charity and for which the grantor can get a charitable income tax deduction. Another popular charitable trust, especially when interest rates are low, is the Charitable Lead Trust, or CLT, as it is stated in acronym form. And the Charitable Lead Trust is considered to be the inverse or polar opposite of the Charitable Remainder Trust. And by definition, a CLT is simply an irrevocable trust which distributes each year a fixed amount known as an annuity interest, or it could be, again, a fixed percentage of the value of the assets, known as a unit trust interest, to one or more charities, either during the life or lives of one or more individuals or for a term of years. And in general, this income stream is called a lead interest, which gives the charitable lead trust its name. That lead interest goes to charity, whereas the charitable remainder trust we just saw, that remainder interest passes to charity. So when the terms of the trust, when the term of the trust is over, the remaining trust property is either held in further trust for the benefit of one or more non-charitable beneficiaries. That can include the donor. Oftentimes it's the children of the donor, or the property can be distributed outright to them. And by the way, this type of trust is more focused on wealth transfer tax benefits, unlike the charitable remainder trust, which is more focused on the immediate charitable income tax deduction and tax deferral opportunities. Well, how does SCLT operate? It operates, of course, with a donor making a donation to it. And this can happen either during life or a death. And if it's a death, the CLT is called a testamentary CLT. It can be named a TCLAT, which is short for Testamentary Charitable Lead Annuity Trust. That always made me think of T-Rex, like the dinosaur. And a stream of payments is made to one or more charitable beneficiaries at least annually. Now, in the interest of time, I'm not going to go into the minutiae of how CLTs work, but you should know that one can structure this during the grantor's lifetime as a grantor trust for income tax purposes, meaning that the trust's income, deductions, and credits are reported on the grantor's income tax return. Or it can alternatively be structured as a non-grantor trust, where those tax attributes are taxed to the CLT for income tax purposes. And this will, of course, impact whether the grantor can take a charitable income tax deduction or not. Sometimes the grantor doesn't want to take a charitable income tax deduction, rather just have the trust pay all those taxes. The grantor doesn't want to be bothered with paying those taxes every year. So that's the drawback. Again, the charitable tax deduction is oftentimes secondary to the other benefits when it comes to these trusts. Well, the CLT can exist for a period of years, and this is not limited either from a temporal standpoint, or it can also exist over the lifespan of one or more lives. So when the trust term ends, the remainder passes to the non-charitable beneficiaries, which I mentioned could be the donor or the children of the donor. And this transfer can be done so as to minimize or eliminate transfer taxes entirely. And again, this is one of the major benefits of using a CLT in a person's estate plan, to avoid or minimize as much as possible those potential estate taxes. Well, in the remaining amount of time, let's go to donor advised funds, or DAFs, as they're known by their acronym. Jeff mentioned them quite a few times. And for those that don't know, they are simply charitable investment accounts where one can make a contribution today and receive an income tax deduction, but later decide, perhaps many years later, which charities will ultimately benefit from that contribution. And that's done through the advisory privileges that the donor has. And I'm sure that many in our audience either know what a DAF is, or perhaps even they may even have one. DAFs have become very popular charitable giving alternatives for many charitably inclined individuals, especially those who might otherwise like to establish a private foundation. Those that want to establish private foundation may not have the seed money to do it, or they simply don't want the ongoing administrative burdens associated with those types of entities. So it's claimed that donor advised funds are really popular. They're so popular and are considered to be the fastest growing charitable vehicles in the US. In fact, DAFs are the #1 charitable giving strategy in terms of growing popularity. Conceptually, a DAF is much like a mini mashup of a supporting foundation and a public charity, but without those high upstart costs and administrative costs that are ongoing, and the level of attention and the time and the effort necessary to run a foundation or a public charity. Also, there's no endowment threshold, so donors can give as much or as little as they want to, to set up a DAF, subject, of course, to those AGI limitations. One of the biggest benefits, and now we're turning to the main advantages of the DAF, one of the biggest benefits of the DAFs are that they're easy to set up and use, and the sponsoring organization takes care of that administrative work. Another big benefit is that the donor is not limited to those lower AGI limitations for private non-operating foundations. Generally, DAFs have the same AGI limitations as public charities do. Well, now to bring this full circle, I'm going to combine several of these charitable vehicles I just mentioned. And so we can go to the next slide. Often individuals who establish a DAF may couple it with their charitable remainder trust and vice versa. And this way, the remainder interest from the CRT properly qualifies, and the donor can, through those advisory privileges I mentioned earlier, make recommendations as to where those funds will go when the CRT terminates and the assets pass to the DAF. And you see that here on this slide. So instead of designating just a charity where you may get locked into the charity that's named to the trust, naming a DAF can give the donor a bit more flexibility. For example, in the future, if the favorite charity of the donor is not so favored anymore. Well, one final strategy before I go is quite popular. And it's not only to couple the CRT with the DAF, but maybe name the CRT as a beneficiary of one's qualified pension account or traditional IRA. These are the taxable IRAs, not the Roth IRAs. So that way, at the decedent's death, the IRA assets pass directly to the CRT. They avoid immediate taxation, and those assets which are taxed typically as ordinary income can be taxed annually over a longer period of time than that required 10-year payout for most beneficiaries under the fairly new Secure Act. Well, I think that concludes my presentation today. So thank you so much, everyone, for your time and attention. I'm going to turn it back over to Kathleen. I think we may be ready to address any questions that the audience has. Thank you.
Yeah, thanks, Jim and Devin and Jeff. I have a couple questions that have come in the chat and a couple others that were submitted ahead of time. But if anybody has questions that we haven't covered in the past 50 or so minutes, please go ahead and add them to the chat, and I'll try to get to them in the next handful of minutes here. So real quickly, I think, you know, one of the things that didn't come up today, but I don't know if any of you can speak to that. This is something that a question that came in from Shelley Yarborough. So Medicaid cuts were principally focused on able-bodied adults under age 65, except for parents with children under 14. So should community foundations be working to increase job training and placement services? Is that something that could get around some of the limitations that have been imposed there? Oh, Jeff, you're on mute still.
So I thought that was directed more at the community foundation staff. So I don't, I think every community foundation around the country has different local priorities and things that they're focused on. And so I would turn to the staff of the community foundation to see how they're responding with their grant making in terms of what Congress has done.
Yeah, thank you so much for that question. And what we aim to do is to match donors and causes. So a session such as today brings forth relevant information, data, insight. So as donors and fund holders are making decisions about their charitable giving, I often describe it as shining big, bright, shiny spotlights on issues of needs as they emerge in the community. And so as with our expert team and with engaged volunteers, we do help to bring that knowledge so that fund partners and donors are making the best possible decisions for their interests, and also understanding where the needs are emerging and bubbling up. But yes, we do think these are all, you know, very important issues as they relate to changes in federal law, policy, regulation, etc. And that is that bridge role that we can play to remain abreast. So thank you again for the question.
Jeff, there was another question that had come in prior to today's call, actually, and I think this one might sit in your wheelhouse, but of course, others are happy to jump in as well. Have you seen any changes to QCDs, and are field of interest or designated funds still eligible to receive these distributions?
Yes, no, that's current law, right? So when the IRA rollover came into law in the Pension Protection Act of 2006, two things that were specifically excluded are DAFs and supporting orgs. We've been trying as community foundations to strike the DAF language, but yes, you can give QCDs to a community foundation, endowment, unrestricted money, field of interest funds, different types of things. That's a strategy that many community foundations have used to kind of get around the DAF restriction. But this is still something very important for community foundations to fix, because a lot of donors would rather say give 10 $3,000 gifts rather than one $30,000 gift. And the easiest way to do that is to put the money in a DAF and then go to the community foundation staff and say, please cut checks to this list of charities. And that's just kind of more immediate and more direct than a field of interest fund or something with those other alternatives, because those are usually sort of more endowed funds where you have a spending budget of the amount you can spend in a given year, as opposed to the QCD for the DAF where you could get all that money out the door right away.
Thank you for that. I'm looking at the time. I think that's about all the time we have for questions. If others had questions that didn't get answered or that you think of afterwards, definitely, feel free to send us a note. And we can try to be responsive to that. But Renee, I'm going to hand it back to you to wrap this up.
Thank you so much, Kathleen, and thank you, Jeff, Devin, Jim, and to all who participated today. This is a fast-moving policy landscape. You heard about several pro tips today and from our expert speakers. So as advisors and fund holders are working for their own unique tax situation, these new provisions, key changes, and implications for your own planning, this gives you a taste of those so that you can be more confident in your engagement and in your philanthropic planning. We hope this boosted your confidence. You came away with some insights and information. And last but not least, please mark your calendars for October 17th. This is part of the work that makes all of this possible, is the Raise the Region Gala, featuring honoree this year, Warren Thompson, Friday, October 17th. With that, thank you all. On to the rest of your day, and we appreciate your time. And thanks very much to the CF Nova team.